Well, markets are taking a bit of a dip here. They didn't like ultimately what Yellen had to say yesterday. They're nervous as it is, and that's reflected in the fact that major averages in the U.S. have not been able to really break to new highs for well over a year now. And the growing loss in confidence among our governments and central banks is, I think, reaching, well, we're getting closer to a tipping point where various indicators, such as the rise in the price of gold, the numerous number of warning signs within the internals of the stock market. In fact, I'd say this is the largest number of warning signs we've seen in decades. I can't remember a time when market internals were so messed up. Yet the markets continue to push higher, all because of all this money printing that's going on around the world. And you know, these politicians, which are central bankers at the end of the day, are pretty blind to a good solution, even though history has presented good solutions, such as in Scandinavian countries in the early 90s that had a big mess on their hands. And there was none of this propping up zombie businesses and zombie banks, and there were no banks too big to fail. And you know, they took their knocks in the early 90s, but that proved to be the wise decision. Their political structure is quite different from the U.S. and UK political structure. So in the U.S. and UK, well, let's talk about the U.S. You know, everyone's focused on the short term. That is, how do I get reelected? And you get reelected by making people feel good in the short term. And so this QE business continues unabated in total around the world. So while the Fed has stopped its QE program, it doesn't mean that QE from other corners of the globe can't find its way into the U.S. markets. The U.S. market remains the tallest standing midget. It's the only one that continues to brush up against new highs that fail. And the scared money that gets printed and ends up finding its way into hard assets. And the tallest one right now is the U.S. stock market. So despite the market still being, you know, very close to old highs, I think the S&P is off only about 3%. It doesn't mean that things are all rosy. In fact, it's the furthest thing from it. So it's really a question of you know, this can that keeps getting kicked down the road. It's really going to go nuclear at some point. It's interesting that Greenspan, who is the king of understatement, if you actually go and forget about the websites that take his words and I don't know, they add their own spin. You don't need to add your own spin. If you actually just look at his interview, his recent interview, and just look at exactly what he's saying. Yes, he's being very, very Greenspan speak, but make no mistake, he's saying that everything right now is unprecedented because of the huge amount of, massive amounts of leverage that are unprecedented, and that makes this time different than the crash in 1987 or the dot-com boom or any of these other situations that were fairly well contained. What we saw in 2008. Now this is my interpretation, he didn't say this, but what we saw in 2008 was certainly due to the chain reaction of things being interconnected. And if it weren't for QE, things would have gone a lot worse. But QE came to the rescue, as you all may remember, well, it started in late 2008, but it was in early 2009 that the markets defied what everyone thought, including ourselves, and they just started to march higher. And in a very aggressive fashion. You all remember that 2009, the markets were up, I think, somewhere between 50 to 60% because of this QE force. And that's the issue right now, is that, you know, with all these central banks going more and more negative, right now we've got NIRP, that just, we've got Japan, we've got Europe, These are countries that have gone negative in their rates. Yellen in 2010 is on record saying that she has no problem going to negative interest rate environment if it came to it. You could probably Google it. That's how I found her text. In fact, I always tell people, you know, things seem so crazy what you hear, but just Google for it, and you can do your own due diligence and find out what's true and what's not. So at any rate, you know, and also you might remember that Yellen in a recent conference, I think a few months ago, said that she would not be opposed to negative rates. So she's held that position a couple times now. But we can see that you know, the internals are not right, and markets are getting frazzled and worn out. But this QE factor is a huge factor, and that is the big wild card. And I would say that you know, we've seen two sharp pullbacks. I would say corrections since last August, and we're probably going to see more, which is actually good because, you know, markets that move mean there's more profit opportunities in both directions, and also for the timing models, which tend to thrive in those kinds of environments. But I wouldn't be surprised to see the markets surprise everyone and start to trade higher and higher. You know, say a year out from now, if we're you know, the S&P and then the Dow and the Nasdaq are up, you know, another 10% a year from now, it wouldn't surprise me one bit. But I think in getting to that level, we're going to see some fireworks along the way. The period we're in is actually quite unprecedented, as we all know, and it's nothing like the 1970s. Part of the 70s, the markets were so dull, and I remember O'Neill telling me that it was a really tough, dry time for trading because you just couldn't make any headwinds in either direction. But that is not now. So in a way, we're better off now than, say, the markets were then. It's just a matter of keeping a very close eye on your positions, keeping your stops tight, and testing your greed factor. I mean, when you start to feel like you want to double up on your position, maybe that's when you should cut and run. So that's another good factor about being in this kind of market environment. It really hones and polishes your skills as an investor and a trader. At any rate, we've got commodities that are tailing back. Oil's tailing back, the market's tailing back. Market and oil have been in correlation, quite close correlation since the start of the year. So there's no surprise there. Keep your eye on gold. It's rallying because, you know, any kind of nervousness or loss of confidence in central banks is a good excuse for the fear factor to engage. And that's what we're seeing. I think a lot of the price movement in gold these days has been based on the fear factor, even though, as we know, gold can move in various directions because there's many cross currents that will affect the price. On that note, I'll turn it over to Gil.
Well, if you guys all recall last Thursday when we did our webinar at that time, I was showing you guys a bunch of short sale, potential short sale setups, mainly because last Thursday I was starting to get the sense that things were getting a little bit euphoric on the upside, and you saw a number of stocks running up, and when you start to see that, oftentimes that tells you that we're getting set up for at least some kind of a pullback. It's turned out to be a lot worse because over the last 5 days you can see that we've gapped down, let's see, at least once, twice, 3 times, 4 times now, gapped down lower as the Nasdaq pushes below the 200-day line. So, you know, the question now is, where are we headed? Well, we're undercutting the 200-day line, so that alone could cause a short-term fake out. But I think it would just be short-term, and then you'd look at the 200-day line as being upside resistance, similar to the situation yesterday with the 50-day line here. So you saw this reversal yesterday. Now you're probably, in my view, probably headed towards these lows, and you may not get there in a straight line, but it looks to me like that's probably where you're headed. And I think it's a matter of having taken some profits in stocks that were extended, and as we've been saying, you know, 15% gains are nice, 20% even better, but if you only have 10 and you're starting to see things start to fritter away, then you probably need to back away and take some profits. So But right now it looks like the short side has been the place to be over the last several days. That's where I've been dwelling, outside of a couple of bouncy trades yesterday on a couple of names. But let's take a look at some of these stocks, and some of them I think you guys probably should have been on. We were talking about Facebook last week and how I didn't like the way this thing was acting. And basically, you know, I didn't like the fact that it was failing to move higher with the general market as the market was continuing to go higher. So you had the market in a sharp rally here, and Facebook's not really going anywhere. And as the market is making new highs, it's starting to back down into the 20-day line, dips below it a couple of times. Now, a week ago, last Thursday, we saw it break the 50-day line. So that puts it into play as a short sale target right there. And you would have been helped out on Monday morning when it gapped down and moved lower. There was a report out from Citron Research, which is the noted short sale outfit. And I guess the guy's last name is Andrew Left or something. Is that right, Dr. K? But anyways, there's a break at the 50-day. So now this thing is in play as a late-stage failed base short sale setup. Okay, so you're no longer looking at this on the long side, you're looking at this on the short side. So you get a rally yesterday up near the 50-day line. If you weren't shorted already, that was a spot to hit it. Now you're making lower lows. Now the question here now becomes whether this undercut of that would have been last Monday's low right here is going to trigger some sort of rally, and we just go into this sort of a bear flag underneath the 50-day line and then eventually move lower. So we'll see what happens here. But I wouldn't be surprised if you filled this gap down here or if you got down as low as the 200-day line. I think, you know, we pointed out the problems with the stock last week in terms of it showing weaker relative strength in comparison to the general market, and that was probably a warning sign. Plus, the other thing with Facebook, in my view, is that everybody owns it. You know, everybody's convinced it's going a lot higher, so everybody's long and strong the stock and thinking it's a sure thing to go higher. And I would have expected that if the general market was continuing higher, it would have gone higher too, but it hasn't. So it's breaking down, and now it's morphing into a short sale setup. So seeing the market rallying off the lows, not surprising. Usually you come in the morning, if I'm short, your best plays or your best profits are seen in the first hour or two. So we're about an hour and a half, a little more than that, into the market day, and then you'll see some sort of a rally which might set up another break to the downside. But you know, names that I've been shorting besides Facebook, we talked about these yesterday morning in the pre-market pulse piece, and Google shortable using the 20-day line at 733.36 as a guide for a stop, and it's breaking lower. So all this is doing, if you look at it on a weekly chart, this is a late stage failed base, and you have two breakout attempts that fail. You have one here and you have one here, and both of the times when it fails you see heavier selling volume, and then after that you form a bear flag. This is just a bear flag. It's not anything more or less as I see it, even though you did get some rallies in the stock that carried up to the 50-day moving average in late May, but that was moving along with the market. So from there it starts rolling over, it starts living below the 50-day, and now you can come after it. At the most you would use the 50-day line, which, believe it or not, is only what? We're at 718. That's still only 3%. Yeah, that's about less than 3% above where the stock is trading right now. So this thing has a lot of room to bust to the downside, and if the market goes lower, this is going lower with it. So I'll tell you some names I'm actually shorting this morning that were up. ATVI, I like this one here. You know, I was long this thing for this move on the upside back here, from here to here, and then again from here to here, off the, you know, bouncing off the 10-day, 20-day line there. But now it's starting to flutter around. They filed for a 171 million share secondary offering, which strikes me as a little bit excessive. But what I'm looking at here, and I know this looks good, but we know what happens when stocks run up 10%. That's what this did from the BGU up to here. That's about 10%, and that may be all she wrote past this BGU. Now, if we look at this on a more macro scale. In other words, looking at the weekly chart. Let's see, I'll ask you guys, what do you see here? Do you see anything here? Anybody want to venture a guess? What do you see here? You must all be sleeping. Come on, there's enough of you out there. Someone's got a pod. Excellent, Scotty. I knew you would get it. But that's a pod. And what characterizes a pod? You know, right now, a lot of people come at me, well, is this a pod? Is that a pod? Is this a pod? Is that a pod? Everything that's a big cup is a pod. It might be a late stage failed base, but what characterizes a pod and its failure-prone nature? As I've written many, many times, it's the straight down and straight up action. And the problem with this is that, okay, you see you're down, let's count, 1, 2, 3, 4, 5, 6, 7 weeks down. And then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 15 weeks up. Okay, it's not spending enough time consolidating anywhere along here to remain in rally mode. Okay, so this is a potential pod, and I know it looks good, and IBD will tell you it's a cup with handle, and watch it's going to break out, and blah blah blah, and you can swing trade your way to infinite gains and compounding your gains, swing trading your life away, blah blah blah. But it's a pod, you know, and you can see it as what it is. I mean, I think that's pretty obvious, as a textbook sort of pod. And if it fails, which would be confirmed by a breach of the 20-day moving average, so this thing's sitting right on top. You had a couple of these pocket pivots. I don't know what this is all about. It seems to me like if they're coming out with a 171 million share secondary, now it's a shelf filing, which means I don't think they're actually offering it just yet, but it's a shelf filing, so it's on the shelf ready to go. And you're seeing these big spikes in volume that would be considered pocket pivots, but they're going nowhere fast. And you know, you have one here 6 days ago, I'm sorry, and you just pull in, and then you have another one yesterday. Now, I'm watching this. I think you get 1, 2, it's held once, twice. Now, the third break is going to take it down. So I'm actually short this thing on the rally this morning. I think Nomura Securities or somebody is calling this thing a buy with a $42 price target. Nothing like being early, I suppose, but that's one thing I'm watching. There are a number of other stocks that look to be in similar situations. Somebody asked me about this one the other day. There's a pod. Straight down, let's see, 1, 2, 3, well, we'll count this first week here. 1, 2, 3, 4, 5, 6, 7, 8, 9, say 9.5, and you start up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 11.5 straight up the other side. Now you're chopping around. You get some heavy selling off the peak here. Now you're below the 20-day line, you're below the 50-day line. This one may be shortable right here using the 50-day line at 74.67 as a guide for an upside stop. Now that's less than $1 away, so my inclination would be to look for some kind of push up in there. You got it off the intraday lows today so far, but let's take a look at this one. But again, this is a pod, you know, and the other thing that characterizes a pod is it's a late stage base. Okay, so a pod is essentially a corollary to the idea of a late stage base, and so you have a long run ahead of it. And so, you know, late stage bases, pods are kind of the same thing in that sense, that they're later stage formations and failure prone. And the pod has a straight down, straight up type of look. So that's one idea. Let's look at, I was actually shorted EA as well today because it was up. And I'm watching this thing, and this is what it looks like. This is not really a pod because it's not really straight down, straight up. But it is sort of a late stage formation. It's been rallying for a long time. I got people telling me about the great story. My son has been onto these for a long time, like a year or more, mainly because he's a video game aficionado. And I have to say I should have listened to him a long time ago, but that's all water under the bridge at this point. And so what you've got here is a breakout attempt here, and it occurs on relatively light volume, slightly above average, but it's not powerful. It's above average volume, and you stall. So you get some stalling up here. And of course, we know that this type of action we'll be seeing at a market top. So once you break the 20-day line, you're below the 20-day line. That's a short, looking for a test of the 50-day line or the low here, which I think is 70.20 something. Let's check that out. 70.24 or 69.96. So I'd be looking for a break there, and they could completely break down if the whole market goes down the toilet. So someone emailed me about this one. I thought this was it's not, well, it could be considered pod-like. It's got, let's see, because it does do a lot of chopping around in the lows, so I don't know, it's not straight down, straight up, but it does get this big straight up move, and once you break the 20-day line, okay, now you're in trouble. It's a short using the 20-day line at 16622, about a buck higher as your stop. So I'm actually short this one into this rally just a few cents higher, so it looks vulnerable. So another one that looked, well, it's busting now, so this is blowing through the 50-day line, but you can see here it's had a long run. You see the long run, and then you come up to this big, choppy, ugly, funky looking structure, and it fails on a breakout attempt here. So right there, there's your base breakout failure, and you try and rally above the 10-week line a couple times, and now it's busting. I actually went short this one yesterday, and it is busting lower. I thought it was a cover at the 200 line, but of course it's going to go lower, so and maybe it undercuts this low before it rallies. But now this is coming into play as a short, using the 200-day line as your stop. You know, I was shorting this thing yesterday up here because you had rallied a couple times off the 50-day, and the third time was starting to fail, and yeah, it's just blown apart. So Murphy's law of shorting says that wherever you cover a short, even if it's after a nice game, the stock will go lower. So just so you know that. Let's see, some other things that are coming apart. These cloud names that have been acting pretty well need to be watched, and I think I talked about this last week. Here's one, Adobe, you know, straight down, straight up. So that's pod-like in the sense of being it's straight down, straight up. It's not so deep, so it's not really, in terms of the depth, it's about 30-something%, so it's not that deep, but it's pod-like, and it is failure prone. So notice how it failed, coincidentally, at the 100 price level, and that's Livermore's short sale rule in reverse. And now it's rolled below the 20 days. So what's the first sign of failures when something is rolled below the 20 day? It did it once before, and that was a fake out. Okay, but now you've got the 100 price level and the 20 day working against it. Now it's broken below the 50-day line. Potentially a short here using, you could use, I suppose, a 20-day line somewhere around 97.60 as your guide for an upside stop, and it's only a buck higher, less than that. So, you know, a lot of these are coming apart, and I think that bodes badly for the market. Here's Salesforce. We've talked about this one before. Now this is straight down, straight up, and 51, and that's probably deep enough for a pod. 35, not quite, maybe 40, I don't know. You want to calc that out for me, Dr. Not that it really matters, but now you're breaking the 20-day line, and this probably is going to fill the gap here and test the 50-day line, and then maybe head lower. I don't know. We'll see. So let's see. Facebook under 113 now. I think, is that the first time I've seen that today? The Dow is rallying. The Nasdaq's down 0.85, but that's not surprising to me because this is the typical pattern. Your best gains come earlier in the day, but you know, you'll see some names continue lower. I mean, you look at the checkpoint, look at the Facebook. This EA is continuing lower. Baba is another one that was a short. I don't know if we talked about this. I was looking for this one actually to get back above the 50-day line, but it was a pretty weak rally into the 50-day line. I went short this one yesterday as well. It's coming in. I would look for a test of the 200-day line. So it really depends on where this market goes. Right now, the Dow's trying to rally, but my view is it's probably money moving into more defensive, bigger cap names in survival mode. So we'll see what happens. Here's Vantive. This is another one that I think is possibly somewhat pod-like. I mean, it is straight down, straight up, and then it continues higher. Now it's kind of rolling over. You had a big reversal off the peak on earnings. And I think we put this on as a pocket pivot here, but it's a pretty good example of why you don't buy things when they're sticking straight up in the air like that. And now it's busted the 20-day, rallied up into the 20-day and the 50-day. Notice how the 20-day, the green moving average, serves as resistance once it's below the 50-day line. I'm not sure why that works so well, but it does. And now you see the stock busting, bouncing off the 200-day line. I'd be more comfortable shorting this up near the 20-day line. So somebody says Adobe earnings coming next week. That's true. So you want to keep an eye out for that. Here's Citrix, another one, straight down, straight up, and now it's starting to come apart. So none of this is surprising to me because we saw it coming. I've been talking about these V-shaped patterns and how they make me a little bit nervous, but I'll play them on the upside, and that's one of the what I call an inverted short sale setup, where I understand how a pod can play out. So you can, as I like to say, you can drink from both sides of the punch bowl of death. And that means you can play the long side, so you drink from the long side on the rally up the right side of the punch bowl type formation or the V-shaped formation, and then ride it back down to the downside. And I think that that can be done, and I'll do it. So I'll play things like Splunk on the way up. But once it starts to give out, and I'll even go back, we can look at Mobileye last year when this thing came apart. And this is sort of a rambling kind of pod, that's similar situation, and it came apart and it just blew apart. So we actually played this on the upside here, and then on the downside on the pod break. So now you're seeing a bunch of these other names starting to look like that. Here's Workday. This one's been acting a little bit better. I'm thinking maybe because you've got Microsoft bought LinkedIn on Monday. That was a surprise. Did that one surprise you, Dr. K, that Microsoft bought LinkedIn?
It was a bit surprising. I don't think the market particularly liked the decision since Microsoft gapped lower. And I don't think Microsoft is nearly as sharp as the Google guys. It's coming down to brain power management.
Yeah.
Google are Class A operation, and I don't think, it's sort of like Apple. Steve Jobs was a one-of-a-kind guy, and in Microsoft, Bill Gates is effectively retired, and the people who are filling the shoes there, I don't think are as rigorously screened, shall we say, as they are at Google. Google's brutal.
So anyways, so that might have put a bid. I know that CRM, which had been in talks with Microsoft, started running up, and that reversed, and to me that put it on watch as a short. But Workday's holding along the 20-day line, so unless it busts the 20-day line, then it does remain viable as a long. But this is what you're looking at on the weekly chart, and I got to think this is eventually going to fail if the general market goes lower. You're seeing stocks trying to pinch to the upside. Dow's off 50 now, so that doesn't surprise me. I think maybe what's going on here is you got the Russell 2000 is the only index near a support level, so it ran into the 50-day. So now we'll see whether this carries through on the upside and stabilize the market. But somehow I got to think that if it's the Russell 2000, the market's depending on to find support and rally. They may be stretching it, but we'll see. So let's see. Did I look at Citrix? Here it comes. It's underneath the 20-day line. This is another one, another V-shaped thing. I think we looked at this. Let's see. McDonald's is one that we've talked about as a short repeatedly, and I think it's shortable on a rally to the 20-day. Disney, the same thing. I guess they now have the new Close Encounter with Crocodile, so that was a pretty tragic thing that happened the other day. And I went short this one at the 20-day yesterday, and it's now down at the lows, and maybe it heads lower. But I think any rally, intraday rally, is a chance to put out more shorts. That's how I look at it. Now I noticed the gold stock. People want to buy gold miners. Gold is acting pretty well, but if we get into a lot of trouble in the general market, and you notice gold gaps up here, it's a smooth move overnight, so it shows up as a gap on the GLD here. And it's just kind of stalling and closing, moving towards the lows of the intraday trading range. So to me, if the market's in real trouble and we get into some heavy-duty forced selling, then what you're going to see is these gold miners are going to reverse and come back down, because they're just stocks in the end. And if people need to sell things to raise liquidity, guess what? They're going to. So, I actually look at, when I see these things gap up, I look at them as tactical day trading shorts, because they'll often come in. So that's something to think about. But I also think if you think you're going to make big money in gold stocks or precious metals stocks, mining stocks, the GDX type stocks, you might think twice about it, because I don't think you're going to get huge upside in any of these if the general market gets into some serious trouble. So, and I think things are really screwed up. You know, I try not to get depressed about it, Dr. K, but you know, you look around and you see all these countries going to negative interest rates. How many countries have negative interest rates now? 16? What's the total?
Yeah, it's quite. You know, and I share your sentiment. You know, as I don't know if you caught it, you might have switched computers, but I said as we move closer to the 40th day, I'm seeing and feeling it on many levels. You know, with people I know or people I know of, or you know, just. I mean, I don't want to get off tangent on this talk here, but I think a lot of people are seeing it, and we see so many some of the smartest minds out there are all in agreement that things are not just unwell. We are in dire straits, and nothing's being done. And the central banks continue to dig a bigger and bigger hole because they're running around like chickens with their head cut off, and they don't really know what to do. And it's very evident in their actions. So, you know, we've said this many times, the Fed's painted itself into a corner, and this corner gets tighter and tighter with each passing month.
Yeah. So, dawn on the 40th day, for those of you who have read Ed Sekoda's book, Gavopoly on the 39th day. All right, so let's get back to some more doggy-looking stocks. So Twitter, you know, because LinkedIn got bought out, everybody thinks you're going to make money buying Twitter. I'm not so sure. So I've tended to look at this as a short on these gaps up, and it's kind of worked, but it's still trying to go higher. What's your take on this, Dr. K? Would you be a buyer of Twitter on buyout rumors?
You know, I don't use buyout rumors to ever trade, so,
Don't.
you know.
Imagine my surprise.
Yeah, you gotta, I mean, I guess if I had an itching to go, you know, play the old roulette wheel, maybe that's the equivalent, but I've never had an itching to play a roulette wheel in my life, except maybe when I was like 8 years old because I like the pretty colors. But, you know, that's just, to me, it's a form of gambling, meaning that the odds are not in your favor. You know, and if the odds are 50-50 at best, then eventually you're just going to break even. But given your emotional mindset, you're probably going to lose because, you know, we're all emotional creatures. So, yeah, anyway.
Yeah.
Twitter,
No, I ain't buying it.
Rumors.
All right, Priceline. I think Priceline is a short, and they handed it to short sellers this morning. It got as high as 13.35. I'm not sure what that was all about. I saw that and I thought, wow, that's looks like a perfect place to short the stock, and it's come in. It's trading right now at 13.12. But if you look at this, what do you see? You see a pod with a handle, which can also be seen as, here, let's look at this. So you see the big straight down, straight up, okay, and then you're chopping around in a handle. So it's a pod with handle. You get resistance up at these highs around 1360, and you're looking for a breach of the 20-day line as a sign that it's heading lower. So let's take a look at the let's take a look at the daily chart. So this is what it's looking like on the daily chart. Let me shrink this. And so, you know, you're wobbling here at the 50-day. I suppose if you busted the 50-day, you could come after it, but the rally this morning was pretty nice. But that looks to me like it's setting up to go lower. And if the general market heads lower, guess what? It's probably going lower too. So that's, and keep in mind that 13 points is 1%. So even though it rallied up to 1335, it's not even 3% above the 50-day line. So this thing, I think it probably is shortable using 1326.25, the 10-day line, as your stop. So we talked about Tesla this morning as being a short. I think if you get it, you know, we've been looking at this as a short for a while, but here's another straight down, straight up. So, you know, you can't really call this a pod because it's part of a more complex structure, but it's the same concept. Straight down, straight up, it can't sustain, and so it tries to form a little handle and it breaks. It reverses here on some heavy volume last week, and now it's coming lower. So I think rallies into the 200-day line at which is now what, at 222, no, 220.96. We said this morning 221 and change, I think it was, but those are shortable. So you can see the markets now, the Dow coming off 70. So you get this rally. I just think it's to suck in dumb longs. You know, a lot of people have been conditioned to buy or be pullback, and I think things are going to get a lot worse before they start to get better. Do we have any amazing questions out there? I only see, I see two comments. That's all we have. Everybody must be sleeping today. Are you just in awe of our brilliant analysis? So let's see. Now, let's take a look at now. This actually was good for a trade. You can see the voodoo type action down here at the 20-day line. It bounces up, but I could see yesterday this thing is not getting any real buying interest, not getting a lot of selling interest today, I don't think. Let's take a look at this. Trading minus 54.1%, so not getting a lot of selling interest really right now, but that could change. So, and this is another one also that could be considered a pod-like structure. So you see straight down, it's been rallying up, it's running into resistance along the 76 level. So this is one on my short watch list on a breach of the 20-day. It actually could have been hit. I shorted some yesterday at around the 10-day line. It was good for a bounce off the 20-day line for a trade, or the 200-day line here, and now it's rolling back over. And if the market heads lower, it's probably going to bust. So that's one I'm watching out. So watching for. Could you talk about MACD stretch versus holding longer? I shorted this AM, but the stretch on Google and BABA was significant. Well, I almost always cover on a MACD stretch on an intraday basis. That's just the way I handle stocks on the short side. Because in this market, you don't know if they're going to turn it on you. And if they do, you know, you don't want to be sitting there short a bunch of stock. You want to be able to reset during the day. So yeah, I see what you're talking about on BABA. I was looking at that earlier. And I was shorted too. I covered it. You see the MACD stretch down here when it gets down there. And now it's turning back up. So now if you covered on that, now you're in the position of possibly coming back after it on the short side, which is definitely a possibility. But you would watch this as it rallies. Notice that the 6 period line, the orange line, has not gotten above the 50 period line. So it's not really flashing a buy signal. So, you know, but I would cover on that. You know, I cover, and then I look to come back after it. I'm watching it rally back up. So, you know, if it gets back to 77.30 or something, I might come after it. Google, the same thing. So you got the MACD stretch and the cross. So you could be covering in here. And now you notice how it rallies up into the 20 period line. It can't go any further. So you could come after it again, and you get $1.50, I guess. You know, wring that out of the position by covering earlier. And now it's rolling back over, but you know, you could have done that right at the 20 period line. So they don't always stop there, and I think BABA's a good example, I believe, of that, because it keeps going higher. But now you're sort of finding some resistance here around 77.11, 12, somewhere around there, and 77 what, 15, 14. Yeah, so you know, this could be the end of the line from here. So, and it is coming in a little bit, so you know, that might be a spot to hit it on the short side. So how do you weigh AMCD stretch? What does he mean, MACD stretch versus holding longer? You know, I don't really understand what you mean. How do you weigh a MACD stretch versus holding longer? All I know is I'm ready to re-enter the stock on a bounce. I'll cover on the MACD stretch. I'm ready to re-enter. So I don't hold stocks really short for long periods of time. I more most definitely campaign them. You know, in other words, I'm looking to continually stay on top of them as they're breaking and rallying, breaking and rallying. That's why I came up with the 620 chart to help me with that, so I'm not sitting too long and getting smacked out of short sale profits when something turns and rallies. So it's an active process of taking profits on the way down and then looking to re-enter on bounces. And you can see with these two examples, it works pretty well. So, you know, and it keeps you out of trouble, and that's my main goal, is to stay out of trouble. So check out ACIA for for IPO, good. Somebody said, oh, okay, that's another question, I think. But I don't, I'm not weighing them in terms of how do I weigh a MACD stretch versus holding longer term. I intend to campaign a stock on the short side as long as it keeps going down, and I will use the 620 chart on an intraday basis to lighten up or go in heavy depending on what I'm seeing on the 620 chart. So I'd say basically the two are not mutually exclusive. In other words, it's part and parcel of the process. I'm also aware of the fact that in this environment you could see another buyout of a stock the way LinkedIn was, and so I will tend not to want to hold heavy positions overnight unless it's a stock that I think has absolutely no chance of being bought out. Examples would be I came in short this morning Facebook and Baba as two stocks that probably have a snowball's chance in hell of ever being bought out by anybody. So, and in the meantime, the smaller things that, like, Tesla, maybe LinkedIn, some of these cloud stocks like Now or Workday or Splunk or even Salesforce, it's possible they could be bought out. So those I would be less aggressive with in terms of holding positions overnight. So somebody's asking about ACIA as a pod. Acacia, an IPO, I'm sorry. Yeah, I guess if you want to buy that, but look at the weekly chart, I wouldn't buy that up here. So, but it's acting pretty well. But I'm not going to buy it, especially not in this environment. You think you're going to make a bunch of money, you buy it up here, you think it's breaking out of a flag or something, I think you're on drugs, but it does look okay on the daily chart. So, maybe it's one to keep on your buy list. Mobileye up today. Well, Mobileye was a short at the 20-day line last week, okay? And it broke the 20 line, so that's a bit pod-like. But again, this isn't really a pod in the sense that it hasn't had a big rally leading into it. It's just sort of a breakdown and a rally back up into overhead resistance on the weekly chart. And now you break down at the 200-day line and you're pushing through. So now you're rallying back up to the 20-day line. That brings it back into position as a potential short sale right there. So yeah, that might be something to watch. Along with the Vantiv we're watching. Somebody says, do you ever use the chalk and money flow indicator? No, I don't. I know that Fred Richards is a big fan of that. I don't know if any of you guys know Fred. Maybe a few of you do, but Fred used to do these CanSlim type workshops before IBD shut him down. He's actually Bill O'Neill's childhood friend. And according to Fred, he's the one who introduced Bill O'Neill to the idea of using computers to analyze the stock market. So, and I never heard about Fred the whole time I worked for Bill O'Neill. I did finally meet Fred after I left, and very smart guy, very sharp guy, and actually has an MBA from Harvard, I believe. And unlike Bill O'Neill, who doesn't have an MBA from Harvard, but I think didn't he tell you, Dr. K, that he had an MBA from Harvard?
That was the running belief at the firm. Yeah.
He went to the management development program, which is like a 2-month summer program that they had, where large corporations could send their best and brightest to go to Harvard Business School for 2 months. I know there are a couple of people at O'Neill who went there. I think Scott O'Neill went, but in my view, if you have to bill yourself as so-and-so, a graduate of the Harvard Business School Management Development Program, you're kind of stretching it. You know what I mean? If you have an MBA, you have an MBA, but citing attendance at the Management Development Program for 2 months during the summer as part of your credentials, I think strikes me as the height of fluffiness. In any case. Etsy, somebody's asking about. I'm not a buyer, so I don't know. Why do you want to buy this? I mean, it looks like it's trying to form a bottom, but I don't know. I think in this market, thinner stocks like this, these little thin stocks, and it trades about 15 million a day in the daily dollar volume, could be vulnerable. So, I see what you're seeing in terms of the constructive pattern as it's trying to build a bottom. Maybe one to keep on your buy watch list, along with that Acacia. So, referring to LinkedIn, somebody asks, buyouts after the fact, of course, are always interesting, but looking at the chart, I see no reason or clue to owning the stock prior to the buyout. No, there was no clue, and it's, let's be real. There was no indication, unless you were buying it down along the 20-day and sitting with it. But here it was starting to look like a short to me. So, there's no... Hey, did anybody catch the BABA short? I noticed it's now 76.84. We'll get to that in just a second. But, I had no clue. And I was actually shocked when I saw the news. I was also very happy that I was not short the stock, because I was thinking about shorting it on Monday morning. So I look at it, and I actually remember it was about 5:15 my time, maybe a little later, 5:20. And I'm looking at my quote screen, and I'm going through everything I might want to short, and I'm looking at LinkedIn, and it's showing 123 something bid, and then all of a sudden it's shooting up to 170, 180, 190. Like, holy cow, what happened there? I should have bought it, I guess. I could have bought it in pre-open, but I don't have a crystal ball. I'm not that prescient. Somebody's asking, did Scott O'Neill inherit any of his father's market genes? I don't think so.
I can answer that. O'Neill at one point asked if I could sit with Scott at least once a week and basically tutor him on the market. So I did gladly. I mean, Scott's a great guy.
Yeah, nice guy.
He's a he's intelligent. I can't say a bad thing about the guy. I mean, he's really he's a good human being, and maybe that's credit. I think it is credit to Bill for however he was as a father to Scott. I think it speaks highly on Bill's ability there. But that said, Scott does not have, and I would say this for generally most people, Scott does not have Bill's genius at all. There's not even a shade of genius in there when it comes to trading the markets. He is an adequate, I suppose I could say he's adequate, but again, that's a big difference between being a genius, as Bill undoubtedly has been.
Yeah, he isn't anymore, unfortunately. So, in any case, so I hope that answers your question, but it's kind of irrelevant to us. I mean, somebody's saying, Scotty, okay, you're saying lots of pocket pivot clues in LinkedIn before the buyout. Well, there are several pocket pivots, and we were playing those for trades, and it came in every time. So, I would say that the action wasn't, since you didn't really have any follow through on displays of strength, it's kind of edging higher every time and then pulling back in. You could say that about any stock after the fact, that, oh, look, there was 2 pocket pivots in the pattern and it got bought out. I'm sure you could see that in a lot of stocks that get bought out. But I don't necessarily know that that was a hard, fast clue that, yes, this stock is going to be bought out, or if there's some way that you could say, oh, if a stock has 2 or 3 pocket pivots along the lows, it's going to be bought out. You can't know. So you could say that, yeah, there are some reasons maybe to own the stock if you bought it closer to 120 on these pullbacks down here in early May, closer to 120, and you would be in it. You could have held it, using the 20 days your selling guide, a violation of it, because you could have been pushed out this day, I guess, the day before the buyout. But it's just kind of one of those luck of the draw type of things. Were you long a thing, Scotty? Were you long for the buyout? Nice. Did you have all your clients in it? Oh, they must love you. Just remember that it was Gilmo who told you to buy it along 120, so remember to tell your clients that, all right? Anyways, I'm glad somebody got it, and I'm glad that it was you, Scotty. So now you can afford your girlfriend, right? No, she's low maintenance, right? I know Scotty's girl. She's very nice. I'm just joking around. So, but that's great, Scott. I'm glad to hear that you were on it and you made that gain. I almost feel a sense of victory in a vicarious way. So, let's see. Somebody says, I'm with you, Gil. Looking at a weekly chart of LinkedIn to look closer to a short. Yeah, it did, but but the great and magnificent Scotty could see that it was going to be bought out. So, if you could bottle that, Scotty, I think you got something you could sell pretty well. In any case, let us move along. Any other brilliant questions? We're getting towards the end of our program for today. But yeah, I think I've given you some things to look at. The BABA's actually rolling back in. Let's take a look at that. See how you could see it running into resistance. So a lot of times you're seeing the 6 line push up to the 20 line. You're getting some resistance. Sometimes I'll put out a short into something like that if I'm seeing it run into some intraday resistance. You could say also, not quite, but almost 50% retracement. Maybe it is a 50% retracement. So 1, 2, 3. Yeah, it's about a 50% retracement back to the upside and then roll it over. So you could come back after it. You notice the market's down 84 on the Dow. We got the NASDAQ and well, still off its lows here. S&P is trying to find, well, wait a minute. Let's see. If I had that up all the time, what happened here? I must have had this up all the time. Whoops. The NYA. Yeah, I mean, these are finding some support off the lows, but we'll see how we end up. I mean, overall, the market doesn't look good. So, okay, where were we? You notice this AEM, I actually did short some at like 52.41 or something like that earlier. It's coming in. Agnico Eagle Mines. And again, it's what I'm talking about. These miners will not just keep going up if the general market starts coming in. And I think also you'll see gold come in. That happened in 2008, right, Dr. K? We had a rally in gold initially, and then it blew apart with the rest of the market, correct?
Nothing was sacred or safe when the market came apart. But that said, gold was the first to rebound and then proceed to hit new highs. So,
yeah.
you know, if we another serious correction, well, of the magnitude of 2008, keep that in mind, that, you know, you shouldn't be owning anything. Hopefully you're on the short side. But, you know, when you do get the bounce, and that's going to be the big question. I mean, if we get another unraveling of markets, how far is down? You know, I mean, what tools do central banks have this time around? Last time they had QE. This time, you know, it's going to be an interesting
they don't have much
situation. Yeah, so I would keep your eye on. I don't know. Well, we'll see when we come to that bridge. You know what we're going to have to do, but it's going to be a very unprecedented kind of market.
I see the lows, the prior lows on the NASDAQ at around 4,200, just above there, as possibly a downside target. And basically that's based on the fact that we really have been, for the last year, we've been in this big, wide, ugly, downtrending channel. You know, if you look at this, it's a downtrending channel. And you have huge swings back and forth, and it sets up a lot of nice, you know, swing trading. But I think it was like right around here that IBD figured out that swing trading was a way to go, at least enough so that they could try and sell people a product, which I don't think is going to work. But, you know, you got a bunch of newspaper writers there trying to justify their existence. And my general take is, yeah, you're so good at the market, you're still a newspaper writer in any case, and a low-paid one at that. So I'm a little distrustful at that sort of thing. And I think that you're in this channel, so you're headed to the lows, and you know it doesn't look good to me. Can Dr. K tell us what his people are saying about Brexit? Well, seeing as how he's in Israel right now, I don't think he knows much about what his people are saying about the Brexit. Do they, Dr. K? Do they have anything to say? You're in contact with people still in London, right?
Actually, it's funny you use the word "his people" because you know I do have Jewish roots and I am in Israel.
That's right.
But you know these days, I mean, of course, actually, these days being the last 10 years, it doesn't matter where in the world you are. You can get your information, you know, at the drop of a hat. You know, as far as Brexit is concerned, you know, I think the general consensus, first of all, more people are saying that Britain should leave the EU. And I think that that they're basing it on accurate data. If you look at the EU economy, if you look at the British economy, Britain joined the EU. You know, about what year was it? If you look at the time they joined the EU to now, the EU has been a complete drag on the UK economy. So you know, based on pure facts, not all this political jawboning, of which you know you can drown in the sea of it. Not just, you know, not just in the U.S. It happens in the U.K. just as well. I think you need to look at the situation for what it is. So, if the U.K. somehow can exit, then I think we're going to see some short, sharp, possible buying opportunities as markets correct. But that said, keep in mind that Bush, not Bush, Obama, the U.S. has pressured David Cameron, the Prime Minister, to ensure a victory that Britain stays in the EU. And these, was it Stalin? Joseph Stalin said those who count the vote, those who vote affect nothing, but those who count the vote affect everything. So keep in mind that these elections can be tampered with. And we've seen this happen before, even in the U.S. a number of times. So that the U.S. exerts that kind of pressure, and that the vote's going to be close. So I think right now we're 53% in favor of Britain leaving. Things could get influenced in the direction that Cameron wishes, and Cameron, of course, wants Britain to stay in the EU because he does what the U.S. says. So if that happens, well, then I guess the markets will have a relief rally because they've sold off 5% now, 6% in anticipation of the June 23rd vote.
Yeah, that's a possibility. If you want some really good background on the whole Eurozone and how it was all set up and the flaws, the inherent flaws, because they had rules about membership in the EU. You had to have debt, couldn't be past a certain percentage of GDP, but they still let Greece and Italy in, even though they had huge amounts of debt at the time relative to their GDP. And so, they fudged it. And because of that, there are a lot of inherent flaws. So there's a great book that I've been reading. It's called The Fall of the Euro, Reinventing the Eurozone and the Future of Global Investing by Jens Nordvig, J-E-N-S, Jens is his first name, and Nordvig, N-O-R-D-V as in Victor, I-G is the author's name. And it's a very interesting book in terms of setting the stage and the background for the formation of the euro and the inherent flaws that it has and its potential for breaking up. And the prediction of the book is that it's eventually going to come apart. So the Brexit could be the beginning of that. But anyways, that's something for everyone to check out. On that note, that we're pretty much done for the day. I want to get back to my trading. I'm noticing Netty starting to turn, flattening out, up 17 cents. Baba's rolling back a little bit. So some of these things have had morning bounces, and now we'd be maybe getting ready for a break that takes us to minus 200 or lower on the Dow. We'll see what happens. I mean, I don't know for sure. I'm just going to roll with it as long as I'm seeing things moving in the right direction for my short sale positions until they don't, they stop going down. And I think, Dr. K, you're making a pretty good point. And we could see a sell-off going into, say, tomorrow, and then maybe we stabilize and fritter around ahead of the Brexit vote, and then maybe that triggers some sort of a reaction rally. But we could break pretty hard over the next couple of days. So I've given you some ideas, hopefully on the short side, that you can implement, Netties being one of them, coming back into BABA, some of these other ones also. So hopefully you've got some ammo in your pocket there that you can use. So on that note, that's all we have for today, you guys. Thanks for showing up as always. We'll catch you next week. Have a great weekend, and good luck in this crazy market.
So long, everyone.